Well, ever wondered how some kids could pick the best stocks rather than the investors who had too much knowledge, who had those Excel sheets, who had information about the companies, but the children still outperform them? Now, in this video, we'll learn how you don't need to be a hedge fund owner or investor or an analyst to outperform them. You can be a simple guy, a person who can do normal 9 to 5 job, and you can still beat them. So, let's start with the video. First point. So, this is inspired from the book One Upon a Wall Street by Peter Lynch. So, let's get started. First point. Ordinary investors can beat professionals. Well, as I said, use your everyday experiences to find great stocks. Now, next is invest in what you know. So, one reason why the children won was because they invested in the stocks they know. The brands like Cadbury, McDonald's, which they were used to or which they consumed. So, products, brands, services you use and trust can be close to winner. So, next is knowledge reduces risk. Investing isn't gambling if you understand the business. So, as your knowledge increases, your risk decreases. Now, next, example USA. Noticing heavy customer traffic at Chipotle before Wall Street upgraded it. Well, now, Peter Lynch says there are six types of stocks. Slow growers. Slow growers are mature companies whose growth rate is 1 to 4% and they give dividends. Example Duke Energy. Next are stalwarts, big steady growers buy during temporary setbacks. For example, Coca-Cola, a global brand with moderate growth. And the third one is fast growers. These are small companies growing 20 to 25% plus. They are potential 10 backers. That means their investment can go up to 10 folds. So if you have invested $100, it can go upwards $1,000. Next is cyclical. Cyclical business are in the form of cycle. So they rise and fall with the economy. For example, auto industry. Ford is also a good example. It works like this wave. Next are turnarounds. So almost close to bankrupt companies or troubled companies with recovery potential. And example American Airlines, which showed tremendous growth, a great bounce back. Next is asset plays, companies with hidden or undervalued assets. See, let me tell you one thing. Peter Lynch says that one must know that when domestic institutional investors or foreign institutional investors or hedge funds or mutual funds know about that company, then it's not a good time to invest. It must be really underrated. It must be an underdog. No one should know about it. Like, just a crude example that you should be the first person who should know about. This is the company where no one knows what are the underlying assets, how does it function, or can it be a monopoly. These kind of things you have to keep in mind, and you can beat other experienced investors. Now, there is this small checklist. So, stock picking checklist. For example, if the name is boring or funny, they are often overlooked. People think that it might not be a multi-bagger. For example, WD-40. Well, the very famous company for removing rust or for parts, automotive parts and all. So, second is unpopular industry or dull businesses. For example, if I say a super art AI company and which gives your answer, make videos and all, it might sound lucrative to you in the first thinking, but mind it, it is not really a good investment because they are overhyped. So, unpopular industry or dull businesses, for example, waste management. Next is spin off from a parent company like PayPal from eBay. Next is low institutional ownership. Example, small regional banks before they grow. See, you must have the ability to see things before they grow. You must see that there would be growth in future and they can be big monopolies. And it might happen that they might not need very successful people to run the company in long term. So next is insider buying. When the employees trust their company too much, they start buying its stocks. So when insider buying happens, that means it's also good stock. Next is company buying back shares. For example, if Apple repurchases stocks, that means Apple is gaining confidence in its future products. That means it's a right time to buy the Apple stock. Next is niche market dominance. Example, intuitive surgical in robotic surgery. For example, there can't be another company like Google. If you have 2 billion, $10 billion, you cannot tamper with Google or Wrigley's also or Coca-Cola also. So the niche market dominance. Next is low debt plus strong cash flow. Example, Alphabet, that is Google. So clear long-term growth opportunity. For example, Tesla. The kind of foundation Tesla has in the EV market is phenomenal. So these 9 things can be a good checklist. Next are what are the numbers you should watch? Well, numbers play an important role in the stock market. So the numbers are earning growth, consistent and above industry average. For example, Microsoft performed better than its peers. So the next point is P to E ratio. See, price to earning. Peter Lynch says that, for example, if a company has PE ratio 1, that it means it will take 1 year for you to recover that money. If it is 2, that it means you will take 2 years to recover that money. If it's 40, then it means it will take you 40 years to recover that money. Well, often companies which have really outgrown themselves have high PEs, but Peter Lynch says that one should not invest in high PE companies because they are overpriced. Next is PEG ratio, price to earning divided by growth rate. If it is less than 1, then it means it is undervalued. For example, Meta drop in 2022. Next is debt to equity. See, the numerator, which is debt, it means so the numerator should be small. So debt to equity should be small, and that means the company has low debt, and that means it doesn't have to give people back or banks back. So in times of downturn, they are safe investments. Cash flow, strong and growing in a green flag is a green flag. Obviously, if a company has a good cash flow, then it's a really good company. But mind it, there are two kind of things. If the company doesn't have any cash flow, then obviously it's a problem. But what if it has too much cash flow? Then the problem is that it doesn't have a future growth. If it has too much cash, that means company doesn't see its future, or company can invest in infrastructure, R&D, and many things. So having too much cash is also a problem. Well, there are always exceptions. Banks are also exception. They have a lot of idle cash and they also have debt. So this doesn't apply to banks. So buying rules: buy when expanding into new markets. Example, Netflix moving into international markets. Next, strong early signs of product success. Example, Nvidia in early AI boom. Next, temporary problems scare the market, but fundamentals are fine. Just for example, during COVID, the Starbucks were closed, but this was temporary. Everyone knew that it is going to end. Insiders are buying, as I already said, when employees start trusting their company more. Now, next is selling rules. Sell when company's growth story changes. For example, BlackBerry after smartphone market loss, or Nokia. Second point, stock overprice versus growth. See, during pandemic peak, Zoom was flourishing. But after that, in companies, normally Google Meet is used. Now, next is don't sell just because market drops. The fundamentals matter. If the fundamentals are strong, if the company's foundation is strong, and if the company is kind of monopoly and it is performing better than its peers, P ratio is low and PEG is less than 1, debt is low, and cash flow is good, then you must not sell just because market drops. Avoid these mistakes. Chasing hot tips or media hype. As I already said, when everyone knows about it, then it's just a hot topic. And it's a time to sell, not the time to buy. So don't buy because of fear of missing out. Buying what you don't understand. See, Just because it sounds really good, it doesn't mean that you should have to buy it. For example, there's a situation people buy a really good stock of a company which they know might fail, but there won't be a problem in explaining that why it failed. They won't be shy of it. But what if they buy? They That's why they buy something fancy. But the thing is, you should buy what you understand. Trying to predict the economy, you can't predict the economy. Over diversifying into bad stocks. Diversification is good, but diversification is really bad. The 2 minute drill. So, in this 2 minute drill, it means that you will be able to tell what the company does in under 2 minutes. For example, what does company do? Why is it undervalued? What will make it grow? Or what could go wrong? Now, next is 10 beggar mindset. 10 beggar means the stock can go to 10x in the value. Most portfolio growth comes from these few beginners. Even for Warren Buffett, only two stocks were really good and they outperformed everything, Apple and Coca-Cola. And the example is Amazon from early 2000 or 2020s. If anyone could foresee what the company is planning to do and whether it would be a monopoly or not, or whether it would perform better than its peers, then they could have made millions of out of Amazon. Now, the final words of wisdom. Do your own research, ignore the noise. Buy what you understand, hold long term. Third is patience and conviction always beat panic. See, when people are greedy, you need to fear it. And are really when people are greedy, then you must be scared. And when people are really panic selling, then you must buy, because that's the time when market will drop. But mind it, just wait for some time, analyze the markets nicely, because don't catch a falling knife. Next is individual investors can win big because they are nimble. See, the truth is you can't have the innocence of a beginner, and this is what Peter Lynch told about in this book. I hope you like this video. For more kind of finance videos, just subscribe to this channel and I'll keep you updated. Thank you.